Hello everybody and welcome to this new video where I want to specifically discuss the numbers and only the numbers for Hims and Hers stock, the healthcare company that I have dubbed the future of healthcare on this channel in multiple videos, and StoneCo, STNE, which I have called the Square of Brazil. These are stocks that I cover extensively on the channel because they are so cheap. And they are very cheap based on my preferred metric, which is enterprise value over gross profit over revenue growth. It asks the question, how much am I paying for each percentage point of growth? And we can see it's very, very cheap for both of these compared to my usual spreadsheet. It's noteworthy to say that the revenue growth expected over the next 12 months is very high for these two companies at 57% expected forward growth over the next 12 months for Hims and 40% for StoneCo, keeping in mind that I've used analyst numbers for this spreadsheet for the sake of comparison. But when I look at Hims, I think 57% forward growth in revenue is a little low. I actually think they're going to be much higher, probably in the 70-ish% range. This is a company that's growing very, very, very fast. And so I can't really explain why these companies are so cheap. At first, one could say they're small caps, right? Their enterprise value is a tiny. So because of their enterprise value tiny, the market can be a little rough on them and move them in big swings. But that's not necessarily always true because you have a lot of overvalued small caps. These are very undervalued small caps in my view. And then the short seller ratios, okay, short selling is a little high for Hims, but it's not that high for StoneCo. So I don't think it's the culprit either here. I don't know why these stocks are so cheap. I really don't know. But the goal of this video is to try to look at how cheap they actually are. And, the market does no discovery. Money managers don't seem to be doing any discovery. I don't understand why they don't screen the stocks for these metrics, because these metrics are ridiculously cheap. A private business would never sell for this cheap. Whether it's Hims or StoneCo, there would not be such a thing as a business in the private sector that would trade for this cheap. It's not possible in my view that you could have a stock be this cheap. When I look at Hims, enterprise value is 1.74 times sales and 2.17 times gross profits. Now, keep in mind, I use enterprise value to take out debt, to benefit companies that don't have debt, because market cap has this inability to penalize companies with debt, and I prefer enterprise value. If you look at market cap, it was mostly used as a proxy for enterprise value. So enterprise value, I think many investors will agree is the better metric to use as far as the price of a company goes. The cost of a company is enterprise value. So I'm at 1.74 times sales, 2.17 times gross profits. It's dirt cheap. And if the stock price does not move or stays in this $6-ish range, if it does not move and the company keeps growing at the low rate of growth predicted by analysts, those ratios will be 1 times sales in 15 months and 1 times gross profit in 22 months. Absolutely makes no sense. And even if you use the guidance, and the guidance, by the way, I've moved it forward a little bit compared to what they had said, because it's very clear to me that they will achieve that guidance sooner than Q4 of 2025. I've moved it by 6 months. It's likely that they will actually achieve it sooner, in my view, if you ask me. But they've guided for 100 million run rate in EBITDA. And this is where I talk to value investors. Sometimes I have a few value investors who come on this channel and tell me how my stocks are hilarious and they would never touch them. So even if you're a value investor, well, look at that. This is a stock that will be trading at 12 times EBITDA in 22 months. Now, granted, it has near zero EBITDA right now because it's a high-growth company. Remember, it's a company that's going at 57%. Trailing growth is well over 80% for this company. Year-over-year growth well over 80%. And in my view, they will be at 70% this year. This is a hyper-growth company that's going to be at a 12x EBITDA in no time. This is a company also where if they stopped spending crazy amount of marketing and decided to harvest Remember, this company has mostly recurring revenue, up to 95% of recurring revenue. They decided to stop investing in R&D and marketing and just decided to harvest their profits. These ratios would be much, much, much lower right now. In my view, that's a very, very, very cheap stock. 12x EBITDA in 22 months, so 12x EBITDA in July of 2025, for a stock which will be growing well in excess of 30% a year, in my view, in 2025. Well in excess of that. I cannot begin to understand how cheap this company is. And this revenue growth really helps me sleep well at night. Because really, when revenue grows that fast, it really lessens any mistakes that one can make buying a stock at a higher valuation. It really lessens them, because all you have to do is wait for a company to get bigger and the company to grow into its valuation. And this is a company, HIMS, that is growing really, really quickly into, in my view, whatever valuation you buy it at. This is a stock that's heavily undervalued, in my view. I don't understand how this company is 1.24 billion. I don't get it. Another stock that I don't get, and I've pounded the table multiple times on StoneCo on this channel. StoneCo is a little bit of a stock that's less popular than HIMS, mostly because it's a pure play Brazilian stock, and a lot of people, if they can't try the product, they don't want to invest. Right, and that would be not true for HIMS either, because HIMS, I've never tried the product, and I'm very happy to invest in HIMS. But nonetheless, the point is cheap. How cheap is StoneCo? It's very cheap. 1.55 times sales and 2.09 times gross profit. Actually, their trailing metrics, these two metrics, are cheaper than HIMS. StoneCo in these metrics is cheaper than HIMS. The only reason why I find HIMS to be much cheaper than StoneCo is because I use forward growth metrics. And on forward growth metrics, HIMS is cheaper than StoneCo. But not by much. StoneCo, if you look at the ratio, it's a stock that will be trading at 1 times sales in 16 months and 1 times gross profit in 30 months. And that is if the stock price does not move up. And again, will this even more ridiculous valuation hold in 16 to 30 months? And I don't believe that at all. Now, StoneCo is a peculiar case for a growth stock. Remember, so this is a growth stock. I mean, most value investors would not even screen for stocks growing at 40%. But even if you forget about the 40% growth, which is the reason why I own StoneCo. I own StoneCo for the 40% growth. I don't own StoneCo for the money that it makes, because I invest in product adoption. That's my style of investing. My style of investing is getting into a stock as it's getting adopted and exiting before it starts returning capital in the form of buybacks or dividends. My style of investing. But if you're a value investor and you look at StoneCo, their EBITDA, the current trailing 12-month EBITDA is exactly $1 billion, 1,000 million. Exactly 1,000 million in EBITDA. And EBITDA is obviously a proxy for cash flow. So the stock right now is trading at 3.41x EBITDA, which is dirt cheap. And if you look at analyst predictions, which as always, take them with a grain of salt. They make it easy to make my own videos. And since I don't follow this stock for value, I feel comfortable using their predictions. In fact, I feel pretty comfortable using EBITDA projections from analysts, because analysts are obsessed with earnings. They're obsessed with EBITDA. They're obsessed with profits. So actually, I put more trust in the 65% number here than I put trust in their 40% number. But if I look at analysts predicted EBITDA of 64% growth over the next 12 months, that means EBITDA will be 1,650 million, right? So 1.65 billion in EBITDA. And then that means that this stock, StoneCo, would be actually trading right now at 2.06x next year's EBITDA. It's crazy. And in my view, this company will see its enterprise value even more benefit as the company keeps piling cash. And it looks like, because this is a complaint, if you remember my last video on StoneCo, I was complaining about their cash pile and saying, what are you doing with this cash pile? Well, this is a company that's surely growing its cash pile. So right now they have 4.3 billion reais, which is 750 million USD on the balance sheet. what are they doing with all of this cash? My last video, I complained. I say, you got to invest in marketing. Come on, what are you doing? You can use this cash to grow faster than 40%. With these projected EBITDA numbers, I am not done complaining about how much cash there's going to be on this company's balance sheet. And so the valuation will get even cheaper if the stock price does not move up, which is why I believe whether you're talking about StoneCo or whether you're talking about HIMS, the valuation will have to have an upward reset. Both of those stocks, in my view, there will be an upward reset because at some point, more and more investors are going to see these numbers and say, wait a minute, they absolutely make no sense. Right? That will happen sooner than later. In my view, these stocks have been ignored for a long while now, and I do not believe they will remain ignored for too much longer, which is why I'm happy accumulating both of them. Anyways, this was not investment advice. This was just entertainment. I hope you were entertained and you like my entertainment in general on this channel. I only provide entertainment. Please like, please subscribe. Thanks for watching. Follow me on X if you can. Have a great day.